Right. Thank you, everybody, and welcome to today's session. This is the second in our series of Finance Act 2021 implications for different industries. And today's own, like we mentioned earlier, is for the energy, utilities, and resources sector. I'll just be happy to announce that we are doing this on a very peculiarized and specific basis to your sector. This was based on invitation only, and we're grateful that you're able to make it. This is something that we've designed not for the crowd, but for people from your sector to come and a robust conversation specific to you. So welcome once again. In terms of be quick, if you have any questions as the presentation goes on, please, you can in the chat box, you can type it to the host, you can type it to any member of the panel, or you can type it to everyone generally to engage in meaningful discussions. If you want to ask your questions, you can do that at the end of the presentation so that we can hear you. The presentation is expected to end in 30 minutes and question and answer will take the remaining 30 minutes. Please, let's keep it engaging. Let's keep it very collaborative. Welcome once again as I hand over to our presenter for today, who is Ayo. Ayo is a tax director in PwC. Ayo has over 20 years working experience in the finance and tax space, working with a global leading international oil company. What does Ayo bring? Ayo brings in high quality tax experience. Ayo brings in key wealth of knowledge from participating in advocacy initiatives, from participating in tax projects, both on a local and a global scale. Ayo is welcome to take us through this presentation, and I'll hand over to you to proceed. Thank you so much.
Yeah, thank you very much, Emeka. Good morning, everybody, and thanks for making our time to join this session. So we'll be looking at key highlights from the 2021 Finance Act, starting off with key changes, and then thereafter we'll look at a couple of insights. We'll try and make this as brief as possible so that we'll have enough time for Q&A and hopefully a lot more interaction during this session. 2021, an interesting year. On a global scale, probably COVID plays an important role in our mind. Then conversations around energy transition and all that. And of course, that has an impact locally in Nigeria with the spate of divestment we are seeing with a couple of the oil majors. One of the key developments in Nigeria was the passage of the Petroleum Industry Act, a reform agenda that's been in the works for close to 20 years, but it was good that we're able to get it across the finish line, finally in 2021. But let's look at some of the key changes in the 2021 Finance Act. We'll be focusing on about 10 of them. Starting with the change or the amendment to the capital gains tax with respect to disposal of shares. Before now, sales of shares, it's exempted from capital gains tax, and that provided a lot of opportunities around M&A, particularly with respect to the EUR, the energy utilities and resources space. But with this amendment, transactions in excess of 100 million will now be subject to CGT. And that would typically be looking at the gains, with respect to those transactions. And of course, CGT will not apply if that disposal is then reinvested in another Nigerian company. And it's important to highlight that this is with respect to disposal of shares in the Nigerian entity. So there are probably opportunities to still do some tax planning around this. So we could have some further conversation around that. So effectively, from 1st of January 2022, disposal of shares in excess of 100 million over a 12-month consecutive period would then be subject to tax. Please, can I request that we mute so that just to reduce distraction and noise level. Yeah, thank you. Another important amendment, that impacts our industry, it's the amendments with respect to export profits for companies engaged in petroleum industry. So whether you're in the upstream, whether you're in the midstream, whether in the downstream sector of the economy. So, but typically, CETA provisions allows entities that earn profits from exports to be exempted from taxes with some conditions. But of course, before the passage of PIA, petroleum companies generally are not subject to CETA. But now that with the passage of PIA and with CETA now applying to particularly upstream entities, in addition to downstream entities that were subject to CETA before now, I think it becomes expedient, to make this amendment to ensure that proceeds from operations from petroleum activities are brought within the tax net. So another important change also is with respect to the minimum tax. Before now, the minimum tax was changed from 0.5% to 0.25% on gross turnover, less frank investment income. But the challenge with respect to the 2020 Finance Act was it was not exactly clear which accounting period is covered, and that brings some level of ambiguity. So the ambiguity has now been addressed and clarity has been restored with the 2021 Finance Act, now clearly stating that the period is now from 1st of January 2019 to 31st of December 2021. Any two accounting periods within this timeline. And of course, it suffices to state that this is expected to be two consecutive accounting period. So when implementing this. The capital allowance restriction, with respect to non-taxable activities, also an important change, reflected in the 2021 Finance Act. Basically, what this provision is aiming to do is to bring to fore, that provision in the law that states that capital allowances are claimed when assets are put in use. So if an asset is not being put into use for the purpose of generating taxable profit, then this basically saying that such qualifying capital expenditure or assets should then not be taken into consideration when determining our capital allowances that will now be offset against the profit that is subject to tax. What's the implication of this? The implication is for entities that have substantial part of their assets, not contributing to the generating of taxable income, then such assets will not be taken into consideration for capital allowances computation purposes. And then by reason of that, the profit that is exposed to tax will become a higher quantum, and the tax authority will hope to generate additional tax revenue. But I think it's important to highlight here that if the proportion of a non-taxable income exceeds 20% of the company's total income, then this restriction will only apply to where the proportion of non-taxable income exceeds 20% of the company's total income. Okay. With respect to gas utilization incentives, the amendment here is basically to avoid the situation where a company could enjoy these benefits more than once. Basically having a situation where you have double dips after enjoying probably the first 3 years of tax-free period and an additional 2 years, making a total of 5 years. Even if that organization is restructured or is maybe due to mergers and acquisition, the asset is transferred, then such an organization or an asset is not expected to be able to enjoy the gas utilization incentives again. So really the key focus is to ensure that, yes, we enjoy the benefits once and thereafter we are not allowed to take advantage of this subsequently. Now let's have a few conversations around the NASENI Act, the National Agency for Science and Engineering Infrastructure Act. This is not a new legislation. It's been around for a long time. But the interesting thing about this legislation is that it's been basically enacted because there were no clear guidance as to how this will be applied in principle. So, but the 2021 Finance Act has provided clarity around how this will be administered, and it has empowered the FRS to be the agency responsible for implementing this law. And really, what is expected is that 0.25% of profit before tax of large corporations and a threshold of 100 million was set. So basically, the applicable entities will be companies that have a turnover in excess of 100 million. And you expect that such entities will contribute 0.25% of their profit before tax. But the interesting thing is that this is a tax deductible item. So effectively, it's the post-tax impact that will then affect our bottom line as an industry. So for an entity, so it's going to be the post-tax impact. So there are a couple of other important changes also. The education tax changed from 2% to 2.5% of accessible profit. And the timeline within which payment is expected. Before now, payment is expected within 60 days, even though in practice, usually most people just basically at the point of self-assessment and the filing of tax return, this is paid along with the company income tax and petroleum profit tax as the case may be. But now the rate has increased from 2% to 2.5%. Impact on the industry, it's in addition to the 0.5% additional charge, then we'll have the PIA amendments now saying that education tax is no longer a deductible cost. So what's the implication of that for the industry, particularly from a cost recovery point of view? Of course, we've always made the point that tax deductibility and cost recovery are not the same. So it will be interesting to know how this plays out also from a cost recovery point of view, because before now, education tax has a dual personality. It's a tax and also a cost at the same time. So it's then taken into consideration, particularly for organizations with PSCs, and they're able to cost recover that cost. Then we have the Nigerian Police Trust Fund. Of course, it's not a new development. It was introduced in 2019, but there was no clarity as to how this would be administered. So the 2021 Finance Act has provided clarity around how the Police Trust Fund will now be administered. It's meant to be 0.05%. So effectively, that's like 5/1000% of the net profit of companies. And in this particular case, there's no threshold. This is expected to apply to all companies operating in Nigeria. So very interesting one there. And of course, the primary objective is to see how this can help to address the current security challenges facing Nigeria, invest in capacity building for the Nigerian police and things like that. Then an interesting dimension that was introduced by the 2021 Finance Act is the amendment with respect to tax administration. Before now, the FRS have tried and implemented a couple of projects and initiatives to embrace technology. I recall the iTax project, the tax promise that is currently ongoing. And with probably one could say that we've seen some level of not particularly high success rates from those projects. But now the Finance Act has empowered FRS to leverage on third-party technology to automate tax administration process, and of course, there are clear penalties for not giving FRS access to our system. So, but the key concern for me is that issues around data privacy, issues around security, have those issues been appropriately addressed? And as an industry, my advice and suggestion would be that it may be a good idea to proactively engage FRS and work with FRS to develop standards and guidelines, that will ensure that the industry data is not compromised by reason of this amendment. So it will be interesting to see if we're able to work with the industry bodies like OPTS, and see how some of these issues can be addressed proactively and not necessarily wait until it becomes issue of dispute and all that, within the industry. Okay, so before we go into the insights, I think there's also one of the key developments that I think should be of interest to us in the industry, which is the part that appoints FRS as the main federal government agency, responsible for dealing with anything related to tax. Is it assessment? Is it collection? Is it audit? Whatever it is, and I think this should be some form of welcome development for practitioners in the industry. Before now, we've had instances where practically any government agency could approach industry practitioners and basically try to enter into the space of a tax practice. For example, I've had instances where maybe the Auditor General or EFCC or a couple of government agencies have approached practitioners in the industry, and they're claiming that they're aware of sometimes maybe to review or collect taxes. Now it's now very clear that FRS is the only agency that have the responsibility to do that. And considering the number of regulatory activities, audit, reviews, and all that, I think this should be, some form of good news, for practitioners in the industry, that now the process is being streamlined. So I'll just touch very briefly on some of the key insights. Of course, some of these have been captured during the course of our conversation. The changes with respect to capital gains tax, we anticipate that this will now make M&A activities probably less attractive, and considering the level of divestment currently going on in country, so that may have a material impact on mergers and acquisition in the sector. Well, the exclusion of export profits, this is consistent with the existing regime. Before now, even though the bulk of crude is sold outside Nigeria, knowing that we really do not have a functional refining capacity. but yet, those proceeds are appropriately subject to tax, and the tax is paid. But now that we have, PIA is basically trying to create a new stream of activities, the midstream and downstream sector. So maybe this is something that maybe worthwhile, to have another look at, particularly to encourage investment in downstream sector, who we probably would have added some value to the process, to the product, and then want to explore opportunities for export. So it seems to me that the key target here is the upstream sector of the industry. But in terms of what we have in the law at the moment, it basically covers the whole full spectrum of the value chain. Yeah, the NASENI Act did indicate that FRS will now administer the act, but it's not exactly clear, the specific administrative provisions, that one would expect to see. Is this now going to start from year 2021, for example? Or are there issues with respect to those years for which there are no clear-cut guidelines on how to comply? Of course, the minimum tax regime, even though it's a substantial reduction, cutting off 50% of the applicable rate, but considering the fact that these are entities that have not made profits, and then in other jurisdictions they're probably getting some kind of subsidy or support from government to get them through that difficult phase of their life. But in Nigeria, they're now being subjected to pay tax, and there's a celebrated legal pronouncement in Kenya, that clearly do not support this line of thought. So it's probably something that might be a good thing for administrators to have another look at. And maybe the Ministry of Finance can basically say we're not interested in killing these companies, but rather would like to see how we can support them and turn them from being loss-making entities to profitable companies. With the additional taxes, now coming on stream, I've heard a couple of times that the oil and gas industry is a sector that is overburdened with multiplicity of taxes. You have NDDC, and a couple of other levies, at various levels, not just at federal level. So now having additional taxes, now being burdened on the industry, it's like, taking it a bit too far. So I think there probably scope to, just the way the FRS has now been streamlined and identified as the main agency of government to manage taxes for the federal government. It's probably a good idea to see how some of these issues also can be streamlined, and we don't get to a point where we basically create tax, for every issue and every challenge we have in Nigeria. So probably at this point, I'll take a pause, and then so maybe we could then entertain if there are questions, if there are comments, and it would be good to have a robust discussion from here.
Thank you so much, Ayo. Yemi can now coordinate the question and answer session. We encourage you to drop your questions, raise your hands. You'll get a notification to unmute yourself and speak. Yemi, over to you. Thank you.
Okay, thank you, Emeka. Thank you, Ayo, for the presentation. There are some questions on the chat box. Anybody has a question to ask, you can either put it in the chat box or indicate, and I would unmute you. So, Ayo, I'm just going to read out some of the questions, and the first one is, how is the levy collected? I think this, I'm not sure what this relates to, but I think it relates to the NASENI, so I'm just going to read it with the next question, which is the NASENI going to be applied retrospectively, considering that it is not a new law?
Thank you. Those are really important and interesting questions. With respect to how the taxes will be administered, I think there's still not enough clarity around that, but I would anticipate that the FRS will probably already actively working on some kind of guideline or regulation, that would provide some insight in terms of specifics. But in terms of practice, I would expect that it will not be materially different from some of the taxes that we have seen now, for example, like education tax, just basically align it with the principal taxes, like SITA or PPT. So if you are filing your PPT returns or your SITA returns, then just basically then file your education tax without necessarily doing anything out of the ordinary. So I would expect that FRS will take that into consideration and make it as simple and as seamless as possible. Well, with respect to whether the tax authority will retroactively apply this law. From a legal point of view, one would say that yes, the law has been in existence, and one would really be expected to comply. But it's practically impossible to comply in this case, where there are no clear-cut guidelines on how, on how compliance should be made. And to buttress that point, that's really the reason why the Ministry of Finance has now gone ahead to make further clarification in the 2021 Finance Act. So in my view, I would expect that the FRS will focus on going forward and providing clarity around how this should play out and not dissipate energy, trying to retroactively apply this principle. Yeah, thank you very much.
Thank you, Ayo. So I wanted to ask if anybody has any question as well. All right. Hi, Ayo. So there's a question. What is your general view about the increase in all the taxes and the multiplicity of the taxes for the industry? So there's now NASENI. There are all these. There's NASENI. There's an increase in education tax. They have restricted capital allowances, gas utilization. Can you please talk us through what you think your general view of the impact on the industry is with regards to all this?
Yeah. Well, it really is an interesting development. I think the industry is suffering from, when you are big, there's really no hiding place for you. And I think that's the challenge the industry is facing. An industry that contributes almost 90% of the foreign earnings of Nigeria, substantial contribution to the overall federal government revenue. So whenever the federal government is in need of resources, it will typically look at those industry, where you have a substantial value, and incidentally, the oil and gas industry happens to be one of such. But having said that, if we put some of the provisions in the Finance Act side by side with the objective of the Petroleum Industry Act, the key part of it is basically to make Nigeria competitive, attract foreign direct investment, and basically grow our production capacity, grow our reserves, So, but with this multiplicity of taxes, that seems to be working, against those key objectives. So it's probably a good opportunity, for the industry to then begin to advocate and play and take a more active role, in what goes into the Finance Act. For example, the police trust fund. I recall this was passed into law in 2019, and it's with very little or no input from the oil and gas industry, even though they're going to pay it's going to impact the bottom line. So my suggestion would be that with the strong industry body, represented by PTS in the upstream sector, and a couple of other associations in other spheres of the industry, I think the industry should take more interest in the tax policy space, and see how it could influence and just basically make very valid points in terms of how the industry is perceived, and encourage the government to move in the direction that is consistent with the strategic objective that's been set in the law, for example, in PIA, which is basically to make Nigeria more competitive, to be able to attract foreign direct investment. The last couple of years, Nigeria has been lagging behind in terms of being able to attract reasonable investment, even with the investment coming into Africa. Very minimal part of that comes into Nigeria. Of course, there are other factors that may have contributed to that, but I honestly believe that the issue of multiplicity of taxes play a very vital role in the mind of investors. Yeah.
Thank you for that, Ayo. Someone asked if we'll share the slides. We'll share the slides. And somebody else asked another question, so I'm just going to read out that to you, Ayo. Concerning education tax that will be assessed and payable within 30 days. For a company that has 31 December as a year end, that will require its accounts to be audited after year end, which cannot be done within 1 month. Does it mean that the company will need to pay this tax in advance?
Okay, look, I think typically what this provision is referring to is 30 days from the date when you receive the notice of assessment from the FRS. Of course, the current regime basically for the upstream entities, the PPT returns is filed 5 months after the end of the year. So typically that would be about the month of May for those entities that year end is 31st of December. And thereafter, the FRS will then carry out its desk review and then issue assessments. So from the date when that assessment is received, we are expected to make payment of the education tax within 30 days. Before now, it used to be 60 days, which means you file your return in May of the following year, say for 2021 accounting year. So you file your return in May 2022. You probably maybe have your notice of assessment 1 or 2 months after that. So that might be, let's say in July, then you are expected to ensure that the education tax is paid in 30 days after that. That would be, but before now it used to be about 2 months.
Thank you for that, Ayo.
Thank you.
Emeka,
sorry to interrupt you. Yeah, a question just came into me privately, and I think it's an interesting question. It came up when Ayo was talking about NASENI, and the question is, even if the FIRS introduces or there is framework for collection of NASENI introduced today, should companies pay NASENI for the 2021 financial year? Now, why is this question interesting? I think it's interesting because for CITA, CITA is filed on a preceding year basis. So that's kind of the basis for companies to say when there's a Finance Act introduced effective 1st of January 2022, that it impacts your preceding year, January to December 2021. But for NASENI, there's nothing like that. There's no preceding year conversation around NASENI. So even if it comes in, should this not affect my NASENI levy that I will pay for 2022, which will be payable in 2023, as against paying for 2021 because there's no PYB? So I think that's a very good question over and above the whole whether they can go back to 1992. So that's one. And I think this is another question. I can't see where this person works, but the question is for companies that get gas utilization holiday. Will those companies now waste their capital allowances? Because if you look at what the Finance Act has said, it says that you should prorate qualifying capital expenditure in the line of taxable and exempt income. Now, if I'm in gas utilization tax-free period, my income is all exempt. So does that mean I would waste all my capital allowances? Remember, I'm not Pioneer that says I can bucket my capital allowances and claim post-tax holiday. So I know that historically there's been that contention, whether or not the capital allowance is utilizable. Now there's even more contention because the clear law says apportion your capital allowances in line with your taxable or exempt income. What are your thoughts, please?
Yeah, thank you. I think those are really, would I say, tough questions. And really, to be sincere, I don't have a clear-cut answer to either of those two questions. And you know, the arguments, you know, are very valid argument to support either position. You know, starting with the NASENI Act. You know, ordinarily, you know, the Finance Act was effective from 1st of January 2022, and then government FRS will be expecting that as you're filing your returns for 2022, you know, returns that are submitted and filed in 2022 will comply with the provisions of the Act. So ordinarily there will be that you know, level of expectation, you know, that this will be taken into account and will be paid. But of course, you know, from a legal point of view, also one could then also you know, argue that adopting that stance would be like a retroactive application, you know, well, maybe not a law in this case, because the law has always been there. But at the beginning of 2021, there's no way, you know, the taxpayers would have known that this provision is going to come up and they will not have made provision for it. So there's a school of thought that could then be interpreted as, you know, a retroactive application of those guidelines. And, you know, ordinarily one would then expect that if this is an issue that eventually ends up in the dispute resolution process, one would expect that it to be resolved on the side of the taxpayer. But of course, this is an area where we expect that FRS will provide clarity and of course, an opportunity for some level of advocacy on the side of the industry, you know, to proactively engage FRS and then put his thoughts, you know, on the table, you know, and you know, basically support proactively, you know, and not wait until FRS have made up his mind and issue circulars and then probably now become a bit more difficult. So I think my suggestion and my advice would be that this is a good opportunity, you know, for the industry, you know, to proactively engage and co-create, you know, a solution, you know, that works for everybody. And, you know, similar thing also said about the second question around you have enjoyed gas utilization incentive, then, you know, how does that then affect your capital allowances, you know? It is, you know, just like you said, Emeka, there's a school of thought that believes that, you know, for capital allowances claimed during that period will then be forfeited and not be carried forward into the future, since that's a period for which you are not paying taxes. But ordinarily, the industry expectation that is that this incentive, you know, it's meant to be an incentive. It's meant to be a sort of encouragement, you know, it's meant to be something that will encourage more investment into the gas space, reduce gas flaring, you know, unlock, you know, the values in the non-associated gas space, you know, knowing that, you know, the cost involved in developing these assets is is huge, and the value in terms of pricing and all that may not be as competitive as what we see in the oil space. So we are giving those incentives in one hand, and on the other hand, you're not saying that, sorry, the benefit that ordinarily you should enjoy, which is available to every company, that is operating irrespective of the industry, you are now being denied, the opportunity to enjoy those benefits. So clearly, that also basically like turning logic, upside down, and like I said, with respect to the NASENI argument, I think these are also issues that, can be brought to the attention of the tax authority and basically articulate what the commercial views are, and the fact that, taking those short-sighted views that encourage or increase government revenue in the short run, but will hurt the industry in the long to medium term, should be discouraged. And of course, if that compelling case can be made, build models to demonstrate that, the returns on investment become significantly lower and not then enough, to attract the right level of investment required to unlock value in the gas space. Then not really one would expect that the government will probably listen and be willing to do what is right for the industry. And of course, these are areas where, as PwC, will be happy to to work with the industry, and support you through that process of being able to articulate this properly and ensuring that we hit the right spot, while engaging.
Thanks, Ayo. Maybe if I could also.
Hello, Emeka. I hope maybe that addressed those two questions.
Yes, thank you, Ayo. I think Chijioke wants to add a few comments as well. Chijioke, over to you.
Yeah, thanks, Yemi. Can you hear me okay?
Yes, we can hear you clearly.
Okay, that's fine. So I was going to say that for me, I think, the question, and thanks to the person that raised the question on, gas utilization, right? Because for me, if we are looking at it from the perspective of, someone who is looking to invest, in a gas utilization project, and we've been talking about the decade of gas and, and the specific incentives for, companies who are involved in gas utilization, you would think that, there would be legislation that would support that investment. And that's, I think Ayo touched on that as well. But then if we now take a strict interpretation of how they have applied this capital allowance restriction, which, in itself makes sense as well, because if you consider that you're claiming an allowance for an asset that was not necessarily used in generating the income, taxable income, so if you balance those two positions, it would then, you'd infer that those assets, for gas utilization projects, you would have lost your capital allowance claim because the income is exempt. Now that's the concern here, because even if you look at the provisions of the law, and the considerations for being able to claim the capital allowance, you'd find out that in the past I would have ordinarily taken my capital allowance from it, right? But even then, if you look at the law at that point, it wasn't even clear. So there was always that gap in the law to say, what should I do with capital allowances for the tax-free period? It's unlike the pioneer, where you're in a pioneer, where you have a pioneer status and you're able to then, the law is clear with regards to what you do with your qualifying capital expenditure within the pioneer period. But here the law is silent. So it's either we're asking the FRS to clarify to us, what do we do with that capital investment? Because for me, it's a disincentive, right? If I take a strict interpretation of how they are looking to apply the law, simply just go and get a pioneer status, rather than take, the incentives under the law, under SETA. So for me, it's still an area that needs some engagement from an industry standpoint, just to give clarity to people who are looking to make those investments.
Thank you. Thank you, Chijioke. I guess it probably is, it needs further analysis, and even from a technical perspective, because there are indeed some provisions in Section 39 that guide capital allowance, talking about acceleration and things like that. I guess, like you said, it is safe to say that if you are a company that qualifies for both incentives, then this can help in terms of deciding whether or not to choose Pioneer over gas utilization because of some of the clarity that's in Pioneer. Another question has come in to me also, and the question is asking around services provided by foreign related parties. And the question is saying oil and gas companies typically have shared service structures with foreign related parties. And the question is around VAT and withholding tax. Now, this doesn't seem like a typical oil and gas, a question that is peculiar to oil and gas industry alone, I guess, but cuts across different sectors. So the question is how to treat VAT and withholding tax on those kind of services that are shared or allocated from foreign related parties.
Hi, Ayo. Did you get to make his question?
Hello, I just want to show you can you hear me?
Yes, we can hear you.
Oh, okay. Yes, I did. Yeah, because you're right. It's not peculiar to the oil and gas industry alone, but considering the values involved, maybe now assumed, a bigger and a much broader perspective, from the oil and gas industry. And typically, companies basically come together and, for the purposes of economies of scale and all that, go to the market together, and thereafter, because we all enjoy the benefits, then that cost is then shared. And incidentally, some of those centers of excellence, or what you refer to as shared service centers in your question, may not necessarily be based in Nigeria. They could be based in other parts of the world, and a fair share of that cost is then shared with the Nigerian entity under a cost sharing arrangement. And typically those kind of costs are at cost, really, no profit element. And and this is driven by most of the joint operating agreements we have in Nigeria. We have those provisions that, as partners, you're not supposed to make profit of each other, So if there is no profit, and ordinarily, considering that withholding tax is an advance payment of tax on profit, one would then reasonably expect that withholding tax will not apply. It's a bit difficult to defend why VAT will not apply, because it's not expressly exempted in the VAT Act, But looking at it also in another dimension, particularly from the point of view of the tax authority, and then from a TP, profit shifting point of view, it's assumed that because we're related parties, so that's why you offer to render the service at cost. That a rational investor will probably not offer the same service to you at cost. And from a transfer pricing point of view, a lot of jurisdictions are now enforcing, a profit element. Even though you claim that this is at cost, they probably want to make an adjustment. And if that happens to be the case, then that then justify the reason why the associated transaction taxes will then apply, with respect to withholding tax and also VAT. So I think in Nigeria, it's still not, is an area that is not really tested a lot yet, because we're still very young in the TP space. But clearly, is an area of risk for many operators, industry practitioners, and is an area that requires some level of detailed analysis, and to ensure that the risk is managed fairly.
All right,
so
thank you very much.
yeah, you're welcome.
Thank you, Ayo, for your response, for your robust response. I'm going to hand over to Emeka now. Thank you to everybody for your questions. I think the question and answer session is closed now. If nobody has any other questions, I will hand over to Emeka to round up. Emeka, hi Emeka, can you hear me?
Thank you. Yes, I can.
All right.
Thank you, Yemi. Thank you, Ayo. I don't know if there are any final questions, comments, anything. Okay, it does not appear that. On this note, we want to thank you, appreciate your time joining us. We hope to keep the engagement ongoing, and we're happy to be of you. If you have any further questions, you can reach us by email. You can respond to the email that sent you the invite. With this, we hope that you enjoy the rest of your day. With the session being recorded, we are able to send you a recording of this so that it can be referred to subsequently. Thank you so much and enjoy the rest of your day. Bye-bye.